Hey, good afternoon, everyone. Hope everyone having a good weekend. So for next 45 to 50 minutes, I'll explain about different SPX strategies for 0 DTE, for 1 DTE, 5-day expiry, all different strategies. So if somebody is more of a day trader or a swing trader, based on your time and your portfolio, you can use whichever strategies which you think are applicable. So first, let us try to learn, right? We all know why we need to do trading, or we all, right, everyone is looking for a second income or side hustle because of the job market, because of inflation, lot of things. So I don't need to explain why we need to take time to learn to create a second income source. So first of all, yeah, understand that, right, we have 85% success, but there is always some black swan event. Suddenly Trump may tweet something, suddenly market can do sudden up and downs. So always maintain your position size. Don't go all in one day. Suddenly that one day can be a black swan event where suddenly some news can come from somewhere. So that's why always go with a smaller position size. Don't invest more than 3 to 4% of your portfolio in any one trade, so that even if you lose on one day, next day you can recover that. So always, right, whatever I share is for educational purpose, not a financial advice. So always there can be such type of scenarios where there can be risk, right? Always you have that 10%, 15%, even if we make 85% success, there will be trades where we may have some losses. So always make sure you trade based on your portfolio, your risk appetite. So before you try to learn about SPX strategies, first thing we all need to understand price, right? In trading, whether you trade stocks, options, futures, cryptos, currencies, whatever you do, basically price will do three things. Any instrument will do three things. One is price will keep going up. That means the trend is upside or upwards. That means price is going up. Or there can be some tickers where price can be going downside, right? That means it is in a downtrend. Suddenly, because of some bad news about that company, or because of some bad earnings, whatever can be the reason, there can be some scenarios where a ticker will keep going down. Or there is a third type of scenario where it will just go 1 2 points up, 1 2 points down, 2 3 points up, 2 3 points down, which is called as a sideways market or a range market or a non-trending market. So one is a uptrend where price keeps going up. Again, it will not just go in one direction. It may go some 10 points up, 5 points down. Again, another 10 points up, 5 points down, like that. So that is called as an uptrend. If something is keep going down, again, it won't continuously keep going down. It may go down 10 points down, again, make a 5 points up. Go another 10, 10, 11 points down, 5, 6 points up. Like that, that is called as a downtrend. But if something is just going 5 points up, again coming down 5 points, 5, 6 points up, again 5, 6 points down, that is a range market. So most of us know about naked calls or naked puts. You can always trade SPX or SPY or XSP or QQQ, whatever it is. You can do directional trades where, for example, if you feel like, or if you see that the chart is looking bullish, it is in a uptrend, you can do naked calls. Or you see that price is dropping, you can do naked puts. But if you do naked calls and price stays in a range market, that means it is just choppy, or it is flat, it is sideways, just going up, coming down, going up, coming down. That is where your naked calls will lose. In the same way, if you buy puts, your naked puts, you will lose all your premiums. But if we do something called as credit spreads, you can make money even in the choppy market, in the sideways market. So you have one third chance for each one. Price going up, price going down, or price staying in a sideways market or in a range market. If you are bullish, if you do something called as bull puts, then if price goes up, you will make money. If price stays choppy, also you'll make money. Sometimes even price go a little bit down, also you'll make money. But if price goes so much down, then you have a risk. In the same way, if you have if SPX is looking bearish or Nvidia is looking bearish, and if you do bear calls, right, rather than just buying naked puts, if you do bear calls, then if price goes down, you will make nice profits. Or even if price stays choppy, you will make nice profits. Even if price goes little bit down than what you expected, you can make profits. So that is the advantage of doing credit spreads rather than just buying a naked call or naked put. You have more probability to make money in the market when you do something called as credit spreads. But I hope that is clear for everyone, right? First, understanding what is a trend and why, instead of just going with naked calls or naked puts, what is the advantage of doing something called as credit spreads? Because you have now two out of three possibilities to make money. If you buy naked calls, if it stays choppy, you lose all your money. Right? But if you do bull puts, whether it goes up or if it stays choppy, also you'll make money. That is the advantage. In the same way, when something is looking bearish, right? Let us say Nvidia is looking bearish. If you do some bear calls, whether it goes down, you will make money. If it stays choppy, also you'll make money. If it goes little bit up, also you'll make money. So that is the advantage by doing a credit spreads rather than just doing a directional trades, one direction, right? When you do directional trade, that means you are just expecting it to go up so much, or you are expecting it to go down. You are missing the third possibility where the sometimes that price will never keep going up or keep going down. It goes up, consolidate, or will be choppy for some time, again go up or again change the direction. So always nearly 30 to 40% of the time it will be in a consolidation. It will be in a choppy mode. So if you buy calls or buy puts during that time, you are taking a huge risk. So that's why the one of the best strategies is doing the spreads, iron condors, iron flies, where you have a lower risk. So now you understood about trend, what is uptrend, what is downtrend, and what is a sideways market or what is a range market. And now you let us discuss like why SPX or why XSP. Right? XSP is nothing but 1/10 of SPX. So you may say that SPY is also 1/10 of SPX, but the advantage with SPX and XSP is they are completely cash settled. That means suddenly if price goes up or down, you don't have a problem of assignment of stocks, right? There is nothing like a stock where the brokerage will assign you. So if you buy Nvidia or you buy Tesla, you buy some other stock, suddenly there can be sudden up and down movement because of some news. The broker can always assign you those stocks, right? Whether they can assign you short stocks or they can assign you long stocks. But when you do SPX, there is no such problem. If the direction goes in your way, you will make nice profits. Otherwise, you will have a loss. But there is no problem of getting stocks assigned and you have to, your complete account is blocked or your margins are impacted. That problem is not there with SPX and XSP. And also, if you are a new trader, right, you don't want to directly go with SPX, you can start with XSP, which is 1/10 of SPX. That means your reward and risk is only 1/10. You can slowly start, and once you gain confidence, then you can go with the SPX contracts. So that is another advantage. Then they are completely cash settled and you have favorable tax treatment. That means Section 1256 allows you to book 60/40, right? Nearly 60% on the long term capital gains, 40 only 40% on the short term. If you trade stocks, then you have to show everything as short term gains if you are not holding them for more than 1 year. But with SPX, even though you trade the same 0 DTE, same day expiry contract, same day options, you can still get the 60% of capital gain advantage. Then there are a lot of brokerages nowadays, like interactive brokers and others, who will allow you to trade nearly 24 hours SPX contracts. That means you can open or you can close the trades even in the evening times uh, when you are not in your primary jobs. That is another major advantage. And one more major advantage with SPX is this is the most widely traded symbol across the globe. Right? That means there are millions of buyers, millions of sellers every minute. So the spreads will be very, very narrow. You don't need to pay a huge price for the spread and bid, right? If there are less number of buyers, less number of sellers, the difference between bid and ask will be so much. That means you have to, if somebody is telling that, oh, I will only sell you at 6405, you are trying to buy only at 6390. There is a 15-point spread. That means you have to go somewhere in between to get the contract. But when there are too many buyers, too many sellers, you can negotiate, you can get a better price. That is another advantage with SPX. It is very, very liquid. It is very hugely traded across all the symbols. SPX is the number one ticker across the globe because of these advantages. And you don't need to look at 10 to 20 different charts. You can just keep looking at one chart. Every day you can make some consistent gains with either SPX or XSP, right? Because SPX is basically like combination of 500 different companies. It is tracking how those 500 companies are moving, and then this SPX ticker will be moving. So that represents nearly most of the market or most of the main stocks. So if you just look at one symbol, one chart, you can trade at the same time. You can trade stocks, you can trade futures, you can trade options just by looking SPX chart. Then, right? So now you got like why SPX or why XSP compared to all there are nearly thousands of stocks. There are hundreds of ETFs. Why SPX? Because that is the number one ticker. That is the most liquid ticker that has nearly 24 bar 7 trading ability. All those reasons, right? Now, again, as I explained, if you are if the why not naked calls, naked puts, but why credit spreads? The major advantage is with a credit spread, you have a fixed risk and fixed reward. So suddenly you buy a call, you are paying some $20 premium for a contract. That means for one contract, you are spending nearly $2,000. Suddenly there is a bad news or something. There can be a huge drop, or suddenly it starts chopping. Even though at the end of the day it may go a little bit up, if it stays choppy throughout the day, you are losing nearly your entire $2,000 premium, right? Or if it goes down, you lose premium. If it goes little bit up, but not as you expected, you will lose. But whereas credit spreads, they are good for the same day. If you are bullish about something, if it goes up, you make money. Or even if it stays completely choppy in the sideways, you will make money. That is the major advantage. Where generally in a credit spread, what we do is we sell one, right? You are more like a seller rather than a buyer. When you are buying a naked call or when you are buying a naked put, you are more like a buyer. Just think like you are buyer of an insurance policy, right? Or you are going into a casino, right? If you are doing a naked call or naked put, you are more like a player. Whereas if you are a seller, you are more like a casino. So you are like the casino company or you are like the insurance company. There might be one or two people who get the insurance policy may get advantage, but 98% of the time or 98% of the other members who pay the premium, the company or the casino will keep the money. In the same way, the insurance company will keep the premiums of all these people. Only one or two may get impacted with an accident or something. Only for those one or two, the company will pay. In the same way, in trading also, when you are a buyer, you have more risk. You have less probability because only if it goes in the direction you anticipated, you will make money. But if it stays choppy or if it goes other side, you will lose. But as a seller, you have more chances to make money. As a seller, you have more probability to make money. So if you want to be like an insurance company or if you want to be like a casino company, then it is better to be a seller rather than a buyer. That's what we do in credit spreads. We sell one contract and also as a protection, we also buy another contract as a hedge. So you are not just doing a sell because suddenly if something goes against your anticipation, there can be a huge risk. That's why you are selling one because seller has more probability for success. But also we are buying one more as a protection or as a hedge so that if something goes, suddenly there is some tweet or news, you have a defined loss. You have a defined risk. You are not risking your complete portfolio because, right? So that is the advantage with the spreads where you have more probability of success and also you have a hedge. So generally what we do, we sell one option contract and then we buy another option contract in a credit spread. Generally, as a naked call buyer, naked put buyer, you are first paying the money to others. Whereas here with the credit spreads, you are collecting the money because you are the seller. Just think like you are the insurance company. You are collecting the premiums from them. And if market stays choppy, you can, right? For example, we pay for the car insurance. At the end of the month, if nothing happened to my car, right, I did not get into any accident, then basically that insurance company is keeping all that 100% of the premium. In the same way, when you are doing selling a bull put or selling a bear call, if the price stays as you anticipated, it stayed choppy or it stayed bullish or bearish, then basically you can keep all the premium. So that is what the trade spreads are, where you are selling a contract, selling a option contract, and also buying another option contract as a hedge. You are collecting the premiums, and basically most of the time you can keep all the premium for yourself. So that is the major concept with trade spreads. So within credit spreads, you have a defined risk and reward. That means you already know that, okay, if I make, I'll make this much money. If I lose, right? For example, if I am doing a SPX spread, right? Let us say I am bullish for SPX. I am doing a 5 point spread. That means my maximum risk is $500 and I'm collecting a $250 as a premium, right? That means somebody is paying $250 to me. So that means my defined reward is 250. My maximum risk is 500. My net risk is 250. If it goes against, then my maximum risk is 250. If it works as expected, my profit is 50%. So like that, you already know when you enter a trade, when you buy a call, when you buy a put, you don't know. Sometimes that premium can become zero. Sometimes the premium can become 50%. Sometimes that can become 150%. You never know what is your anticipated risk and reward. But here, when you enter, most of the time we know that, okay, this is my max risk, this is my max reward. If I let it expire, then I can keep all this money. Or if it goes against my direction, this is my maximum loss. Like that, you already know all those things. And generally, if whether whenever there is neutral, market is neutral, or whenever you can see there is a proper direction, this is the best strategy. Naked calls, naked puts. Only when you have a 100% commitment on the direction, you can do naked calls or naked puts. But here, whether market stays choppy, market stays sideways, or you are confident about the direction, so you have more probability of success with the credit spreads. So within credit spreads, mainly you have two types. One is called as a put credit spread. One is called as a call credit spread. Right? What do you mean by put credit spread? Whenever you are bullish about something, let us say you are bullish about Tesla, right? For example, right? Even though we are mainly talking about SPX, just for example, I'm giving you Tesla example. If you are bullish about Tesla, you can buy Tesla calls, right? But if suddenly Tesla stays chopping, last week it went up, but it will not keep going up, right? Last 3 4 days it was keep going up. Maybe next 3 4 days it may stay chopping, right? That means it will stay sideways. It will just go 2 points up, 2 points down, 2 points up. That means when you do a naked call with Tesla, you will lose all your premiums because of something called as theta decay. Theta decay is time value. As you if you buy tomorrow morning, you buy Tesla calls for the coming Friday. Next 2 days, 3 days, it is not moving at all, or it is just going up, coming down, just going up, coming down. Then you will have a major risk. Whereas if you buy a bull put, that means you are bullish about Tesla, and whether price goes up, you will make money. If price stays choppy, just going up, coming down, going up, coming down, still you will make profit. So instead of buying calls here, what you are doing is you are selling a put and you are You are not just selling a naked put, you are also buying another little lower strike put. You are selling a higher strike put, buying a lower strike put. In that way, if stock stays choppy, you will make profits. If stock stays goes up, you will make profit. If stock drops little bit, also you will make profit. So you have a lot of possibilities to make profits compared to buying a naked call. Right? That is the major advantage. So whenever you have a bullish bias or you are neutral that market will stay choppy for that company, you can do something called as a bull put. So rather than buying a call, you are selling a higher strike put, you are buying a lower strike put. So if price stays above that higher strike, you will make money. If price stays somewhere in between, you can make money. But if price stays below the lower strike, that is where you have a risk. So whenever you are bullish or whenever you are think that price will be little choppy in a sideways market, you can do something called as a bull put spread. So in the same way, what is a bear call? Bear call spread or call credit spread. Whenever you are bearish about some stock, right? For example, for Nvidia, you are bearish, right? After earnings, it stayed choppy and then it is right little bearish now after earnings because the expectations were so much, but it did not move so much. So it is little bearish. So if you buy the puts, suddenly it can stay choppy in the complete next week. Or suddenly if there is good news, it can go up. So you have more risk. But if you buy a bear call spread, that means instead of buying a put, you are selling a call of a lower strike and buying another call of higher strike. Then you can collect a premium. If it stays choppy, you will make money. If it stays bearish, you will make money. If it goes little bit up, you will make money. And that is called as a bear call spread. Whenever you are bearish about something, you can collect premiums by doing a bear call. Whenever you are bullish about something, you can collect premiums by doing bull puts. So you have much higher chance of success in this scenario because market, right, as I mentioned, market can go upwards, market can go downwards, market can go sideways. If you do naked calls, naked puts, you have only one out of three chances. When you do bull puts or bear calls, you have two out of three chances. So you have more possibility, right? Nearly 40 to 50% of the time, market will stay choppy, consolidated in the evening times, in the slow days, unless there is a major earnings, unless there is some major good news or bad news, market will be little sideways or little choppy. That's where you can take advantage of these spreads. So first thing is you understood why SPX or why XSP are the best tickers. So you don't need to look at hundreds of charts. That is the most liquid ticker. That is the number one ticker in the entire globe. And then why trade spreads? Why bull puts? Why bear call spreads? Now there is something called as, so now you understood about what is a bull put and what is a bear call. Anyone has any questions on bull put and bear calls? Right? Whenever you are bullish, we do something called as bull puts. Whenever you are bearish, we do something called as bear calls. Right? I'll explain with some live examples. But there can be some days where it will stay in a choppy, right? For example, Mondays. If there are no major events, no major reports, no major earnings, you can make money on the upside. You can also make money on the downside. You don't need to just go with one direction. If you think like, right, let us take some example of NVIDIA. Let us say Nvidia is 175 now, right? Let us just assume that Nvidia tomorrow is Friday. If you think Nvidia will stay between 175 to 178, then I can do a bear call of 178 180. That means yeah, as long as Nvidia stays below 178, you can keep all that money. In the same way, if I think Nvidia will stay above 175, I can do some 175 173 bull put. That means I am selling 175 put, I am buying 173 put, and I am collecting some money, right? Because somebody is thinking that it will go much higher or it will go down. So he is paying a premium. But because with the tools, because with the knowledge, if you think like Nvidia will stay between 175, 178, you can do a bull put below 175. You can do a bear call above 178. So you are collecting money from both the sides. You are not just doing bull put, you are not just doing bear call, because you know that it is in a range, it is in a small sideways market. Then you make money on both the sides. If price stays between 175, 178, you can collect the premiums. You collect some $100 at the top, you collect $100 at the bottom. That is called as an iron condor. Iron condor is a combination of a bull put and bear call. You are not just doing bull put, you are not just doing bear call. You are going to the maximum point where you anticipate the price to go up. You are selling a bear call above that. You are going to the minimum point where you are expecting that is the support, that is max low it can go. Then you are doing a bull put. So the iron condor is another strategy where you can make money on both the sides. You are not just taking premium on top or premium on bottom. You are taking both the premiums and you can keep money. If price stays in between both those values, you can keep the money on the upside and also on the downside. So again, whenever you think market will be in a choppy, in a range, right? That is where you can use this iron condor strategy. If there are some major events, then we go with bull puts, bear calls. If you think market will be choppy, there are tomorrow, let us say there are no events. SPX may stay choppy in a 30, 40 point range. So you can go 40 points up, you can go some 20 points down, you do a bear call on the 40 points up, you do bull puts on the 30 point down, then price stays in between that, you make money on top, you make money on bottom. So this is where you can make more profit. So with the, if it stays choppy because of the theta decay, time decay, if market stays in a range, this is the best strategy. Then there is another strategy called as iron fly strategy, which is also called as iron butterfly strategy, where you can, you are not just trying to do a bull put and bear call. You can sell calls at the money and you can sell a put at the money. And if price, again, it is a, if whenever market is in a range, these iron condor, iron fly strategies works best. That means if the premiums will be very, very high at the current, right, at the money, right? If SPX is at 6,500, if you sell 6,500 call, 6,500 put, you are buying a 6,520 call, you are selling a 6,480 put. And if price stays choppy there, then because your premiums are high at the place where your current price is, if it is just right on Friday, for example, we did a short fly, price was staying just up and down, up and down, up and down. Within few minutes, we made nearly 700 to $600 on each contract. Right, that is where the iron flies will help you. Whenever market is choppy in a range, if you think price will stick to some point, if you can sell a call, sell a put around that price, then if price stays around that area, you will make nice profits because of the theta decay, because of the implied volatility. You will make huge profits with the iron fly strategy. So again, just to repeat, instead of buying naked calls, naked puts, because you have low probability of making money unless there is a major event, unless there is a major positive or major negative news. Naked calls, naked puts always comes with a high risk, because if suddenly, right, especially first half an hour, market will be so volatile. Suddenly it will keep going up, keep going down, going up, going down. Then nearly from 9:30 to 11, 12:30, 1:30, market will be choppy. It will be just moving in a sideways direction. So most of the nearly 6 to 7 hours of window, nearly 4 to 4.5 hours of window, SPX will be choppy unless there is a major event. So to take advantage of the theta decay, right? If you trade after 9:30, if you can use iron condor strategy, you can use bull put, or you can use bear call, or you use iron fly strategy, you have high chance of success. So that is what, right, we do with SPX. Just right initially you can start with XSP, and then you can start with, once you gain confidence, you can do the same thing with SPX, because with SPX you make more profits, or if you do something wrong, you will also lose more. So we have some indicators which will help you to make consistent gains. We have nearly 90% success with our 20 delta rate spread. We have some 50 delta. I'll explain all those things. But first of all, I want you all to understand what is bull put, what is bear call, what is iron condor. Iron condor is combination of bull put and bear call. Iron fly is basically similar to iron condor. Only thing is here you are selling a at the money call, at the money put, and buying a 20 point or 30 points up and 30 points down, puts and calls. So these are best for whenever you feel market is in a range, in a small choppy area, then these iron flies will make you huge profits. So there are 5 different indicators which will help you to make consistent gains. We have nearly 85 to 90% success. I'll explain one by one. Right, the first one is called as SPX credit spreads. So in this SPX credit spreads, right, this indicator will tell you what to do, right, every day. So nearly we have 90% success with this indicator. For example, every day morning it will say, okay, you sell bear calls, right? Around 9 o'clock, you will get a message because it looks at the market volume, whether buyers are in control, sellers are in control, and then it will tell you that, okay, overall market is looking bearish. You can sell bear calls and collect around $100, right? That means if, for example, right, so you are already, whenever you got a message, you are already in a sell signal. Then immediately what you can do is, for example, now you are at around 64.85 or 64.90. Then here, if you do the exact at the same price, you will collect around $250, right? For example, you are at 64.85 or 64.90. If you do a bear call here, you sell 64.85 call and you buy some 64.90 call, you can collect $250. But what we are doing with this indicator is we want to take low risk, right? This is especially important for members who don't have a lot of time to trade during their office hours. So what they can do, you can always go a little bit up, right? You want to take very low risk. You don't want to collect 250. You go somewhere here, 6,500, and you do 65. You sell 6,500. You buy 6,505. So on the day, if price stays below 6,500, all that money is yours. You don't even need to close the trade, right? So again, so this is called as SPX credit spread daily income indicator. At every day at around 9 o'clock, you get a message telling whether you should do bull puts or you should do bear calls. It looks at the volume in the first half an hour, and then it will suggest, okay, now the market is looking bearish. You can collect this much money, around $100, at the existing or the next sell signal. That means if you already have a sell signal, you can take a bear call. So wherever you can make $100 spread by selling the calls. So if you do here, you will make 250. But we want to take low risk. So you can go up and you do a bear call somewhere here. That means if price stays below that, also all that, right, that a day entire price dropped, it stayed somewhere here. So that means all that money is yours. So again, if we go to the next day, again it gave a message, you can sell the bear calls around $100. So you will go up and sell somewhere here. So if the price stays, so if you are already in a sell signal, you can take. Otherwise, or in the next sell, whenever you get the sell signal. For example, now it is going up. Whenever you get the next sell signal, you see where is, so this is 50 delta. That means you collect $250 on a $500 spread. But we are telling only 20 delta. That means you go a little bit up, where you can only collect $100. And you collect that $100. And if price stays below that price, below that level, then all that money is yours. So that entire day price stayed below that level. Then you can keep all that money. So in the same way, for example, here on 3rd September, sell bear calls, collecting around $100 at the existing sell or the next sell. If you are not in a sell, say you don't see any sell signal, then you wait for the sell signal. Whenever you get the sell signal, you take a bear call, and if price stays below that area by end of the day, all that money is yours. So you are doing sell somewhere here, then you can keep all that money, right? For example, this is 4th September. It is telling sell bull puts, right? By looking at the first 30 minutes volume, it is telling, okay, market is looking bullish. You can sell bull puts, collecting $100 at existing or the next buy. If already you are in a buy signal, you will take it. Otherwise, whenever you get a buy signal, you go below, right? If it is bear calls, you have to go above, select the premiums, and you take it. If it is bull puts, if it is telling that you sell the bull puts, market is bullish, it is telling now you sell the bull puts, collect around $100. That means whenever you get a buy, you sell somewhere here. If price stays above that range, right, by end of the day, price is price went all the way up. So all that money is yours. Right? Again, this is on Friday. It says sell bull puts collecting $100 at existing or the next buy. So as of now, you are in a sell signal. So whenever you get a buy signal, right? For example, we got a buy signal here. So then you will go here, right? We did 64.40, 64.45. We went below, we did a 64.40. That means price stayed above that. Then all that money is yours. So by end of the day, if price stays above that, then you can keep all the money. So all you are doing is just whenever whatever it says, you have to just follow that, and we have nearly 90% success with this trade, where you just do one trade, you don't even need to watch it whenever you go, right? So if it is already in a buy now, you can do here itself, but if it is dropping, then you wait for the next buy. So if already existing buy or next buy, if already buy is existing, you do it that. Otherwise, if you are in a sell signal, right, around 9:05 already it started dropping. So whenever you get a next buy, you will collect the bull puts. So like that, every day you can just do one trade, right? Whenever you get a buy, you do the bull puts. Whenever you get a sell, if you are already in a sell signal, right? Or whenever you get a sell signal, you go up, do the bear calls somewhere here, right? If you are a high risk trader, you can even do 50 delta. That means at the current price. But if you don't want to even manage the trade, you don't want to keep looking at the charts throughout the day, you can just go up and do a 20 delta. That means you are going 15, 20 points up, and you are doing something here. Then if price stays below that area throughout the day, then all that money is yours. So like this, 9 out of 10 times you can keep them, unless suddenly Trump comes with some tweet or something, or some bad news or good news happens. 9 out of 10 times you can keep money with this strategy. So is it clear for everyone? Right? All we are doing is indicator, wait until 9 o'clock central. At 9 o'clock central, it will print you. It will tell you that, okay, market is looking bearish. If you are already in a sell signal, you can do a bear calls. So if you go to your brokerage platform, Thinkorswim, Robinhood, or Interactive Brokers, or whichever, then if you go and see the spreads, it will tell you, okay, here you can collect 250. If you do here, you will get 250. If you go a little bit up, 200. Here 150. Here $100. So for a low risk, what we are telling is you can, instead of doing here, you do here. Then 95% price will stay below that area, below this range. That's what we are doing with this indicator, where you do the bear calls or you do the bull puts based on what it is telling. So that is the first indicator, right? So that is where we are doing it 20 delta trades. So that means on a $500 risk, you are collecting 100 to $110. 90% of the time it will stay below that range or above. If it is a bear call, it will stay below that range. If it is a bull put, it will stay above that range. Then you can keep all that money for yourself. Then the next one is called as 50 delta trades, where we use a 30-minute time frame. For the first one, we use 5 minutes time frame, whereas for this one, we'll use something called as 30-minute time frame. So for example, here you receive something called as a bear calls, right? It is telling, okay, now you can do a bear call spread. Here you enter whatever you get here, right? That means you will immediately do 64.80, 64.75 bear call. Then if price stays 64 below 64.80, then all the money is yours. If you get entry here, you do a bull put at 50% strike. Then if price stays above that range, by end of the day, you can keep all 100%. So you got a entry here, you got entry here. Then you do 50 delta. That means instead of going down, you are directly taking at this strike 64.40, 64.45 bull put, 64.75, 64.80 bull put. Like that. So you got an entry here, right, for a bear call spread. That means wherever you get you will do 64.80, 64.85 bear call. Then if price stays below that range, you can keep all that money. Like that, here, instead of using 5 minutes, we use 30 minutes and we do 50 delta trades. That means if you get a bull put, you do a bull put at the 50 strike, right? At the 50 delta strike. That means you are collecting $250. So here you got a bear call spread. You do a 50 delta bear call. That means if price stays below this area throughout the day, then all that $250 is yours. Again, it came all the way down and then started going up. You got a bull put entry. Then we did 64.40, 64.45 bull puts. Then if price goes up and stays above 64.40, all the $200 to $50 is yours. So like that, whenever you get a bull put entry, you take at the exact strike, right? Because now you are looking at a 30-minute candle. That means you have more confidence that price will go up. You are looking at a 30 minutes bearish candles. That means there is a high possibility price will stay below that. So you are, instead of doing a 20 delta, here you are doing a 50 delta. So you are collecting 250 on a $500 risk. So if it goes, right, as long as price stays below this area, then all that money is yours. If price stays above this area, all the $250 is yours. So you can make money on this side. You can make money on this side. So on a $500 risk, you took 250 profit here. And again on a $500 risk, you can take 250 profit here. So that is called as a 50 delta SPX trades, where again these are 0 DTE. That means you are doing a trade for the same day expiry. On the same day, if price stays below this area, then all that money is yours. If price stays above this area, all that money is yours using a 30-minute time frame. So that is 50 delta trade. Then we have something called as bed and breakfast trades, right? What do you mean by bed and breakfast, right? Sometimes you don't have a lot of time because of your job. You can do something called as, right? For example, at around 2 o'clock, 2:30, you get a signal. It is telling that it will be bullish for the next day. Then that means before the close of the market, you can see whether it is bullish or bearish. So it is telling it is bullish. Instead of today's expiry, you will do a bull put for tomorrow's expiry. You will do some bull put here, collect $250 or $300 for the next day. And then if mostly there will be a gap up. That means overnight there was some bullish move, price moved up. Then in the first 15-20 minutes, you can close the trade. Whenever market opens, you don't even need to wait for throughout the day. Whenever you see that bed and breakfast is giving a bullish indicator, you do a bull put in the last half an hour. That means between 2:30 to 3, you do a bull put. Next day morning, when market opens, you will make 30-40% profit. You just close the trade. Again, 2:30, you got a BNB bullish indicator. Then again, you can do a bull put indicator for the next day expiry. That means this is 1 DTE. The first two trades, they are 0 DTE. Here, you are doing 1 DTE, where If your bed and breakfast is telling it will go up, you can just do a bull put. If, for example, let us say sometimes it will say price will drop. Right here it gave price will drop. Then next day morning price drop. So within first 15-20 minutes you close the trade. Here it gave it will drop. Then next day morning there was a huge gap down. So here it said it will drop. It dropped. So like that, if it says it will go up, you take a bull put. If it says it will drop, you take a bear call, and suddenly when market opens, you just close the trade. You don't wait. You open a trade in the last 15 minutes. You close the trade in the first 15 minutes. So you are not waiting for 100% expiry or something. You want to take advantage of that overnight income, right? Because overnight there was a gap up, you make 30-40% when market opens. Here you take a trade, when market opens, you make 30-40%. So this is for 1 DTE trades. We use BNB. So again, the concept is same. You are doing bull puts whenever you see a buy signal. If you see a sell signal, we can do bear calls. Again, we use 30 minutes time frame for this. Then the next one is called as tag and turn. Right? What is tag and turn? Again, we use 30 minutes. This is for 5 DTA. That means instead of today's expiry or tomorrow's expiry, we are going with 3 or 4 or 5 days from today. Right? For example, on 2nd September, we saw the buy signals. Right? Price came all the way to the bottom of the band, and we got buy signals. Right? It came, and then we saw buy signals here. Then we took the bull puts. Right? On 2nd September, we took bull puts for 3rd September. We took for 5th September. Like that, you can take bull puts for nearly 5-day expiry. Then price went all the way up. On Friday morning, we saw a sell signal at the top. Then you can do bear call for the day or for the next day or for 5 days expiry. Then there is a possibility minimum price will come till here or it may come all the way down. So if you are busy professionals, you want to do swing trades, you can just wait for these buy signals or sell signals, and you can take 2-day, 3-day, 5-day expiry trades. If you can only focus 10 minutes before close, 10 minutes before at the open of the market, you can use BNB. If you are more, you can spend more time, then you have with the 5 minutes or with 30 minutes, you use 50 delta trades. With 5 minutes, you can use this 20 delta trades. Then there is one more called as iron fly. Same way, you can also do, right? Just like you do bull puts, bear calls, you can buy iron fly. That means you buy a call, buy a put at the money, you sell a call somewhere at the top, you sell a put somewhere at the bottom. Price goes up, you make nice profits. So based on market, sometimes it will tell you can take rate. This is very, very good opportunity. It's telling you can sell at the money call, at the money put, and you can double the size. Not just one quantity, you can take two contracts. If you generally take one, you can take 2 times now. If you take two contracts, you can take 4 contracts. It is telling that price will. So that means you are selling a call, selling a put here, and collecting nearly nice premiums. And as a protection, you are buying some call, you are buying some put here. So if price drops from here, then you will make nice profits. So here it is telling sell iron fly on current sell or the next sell. So you can sell a call, sell a put whenever you get the sell signal. Then if price stays below that, then you will make huge profits. So now you are doing both. You are selling a call, collecting premium, selling a put, collecting a premium, and you are buying some call somewhere at the top as a protection. You are buying a put somewhere at the bottom as a protection. So if price stays choppy somewhere here, then you can keep all the money. Here you are collecting nearly $20, $25. And if price stays somewhere around this area where you sold the call and put, then you make nearly $1,000, $2,000 with each contract. So as long as price stays in a choppy or in a range market, right? Price came all the way down, came up. So because of this theta decay implied volatility, if you collected $20 here, when price is coming back all again to the same price, you can buy back at $10, $12. You collect nearly $1,000 profit. Right? With a bear call bull put, you are risking $500 and making 110, $120. With a iron condor, you are risking $500 and making $250. With a iron fly, you are risking $2,000 to make $2,000. So you have 100% profit possibility if the market is in a range. So like that, again, right, we are instead of doing naked calls, naked puts, one is you can do trade spreads. Whenever it says bear calls, you can just go up and do the bear calls. And if price stays below that area, then you can keep all the money. 9 out of 10 times you will make money. For 50 delta, instead of 5 minutes, we go to 30 minutes. Whenever it says that it is bullish, that again, you can see all the live videos. So if it says bullish, that means price came to the bottom, started going up. You do a 50 delta trade, and if price stays above that, all that $250 on a $500 risk is 100% yours. But all you need is price to stay above that area. So whenever you get a bull signal, you got a bull signal, you got a bull signal. That means whenever you see a bull signal, you go and do a bull put at the bottom here, where you collect $200, $250. So if price stays above that area, by end of the day, all that money is yours. That is a 50 delta, right? 20 delta means you are collecting 100, 110, 120 for a $500 risk. 50 delta means you are collecting 250, 260 for a $500 risk. Whereas BNB, you are collecting nearly 250, $260, but not for today. You are collecting for next day, because in the last half an hour, 1 hour, there is a lot of bullish pressure. There is a lot of buying volume. That means there is a high possibility for SPX to go further up next day morning. So you are collecting that premiums. So even if it stays choppy, also you'll make money, right? You don't need it to go up. If it goes up, you'll make more money. But even if it stays choppy on Friday, right? Thursday, we got a buy signal. If it stays choppy, also you'll make money. If it goes up, you'll make money. If it drops little bit, you'll make money when market opens. Then you can close the trade. When market open, it moved so much up. You don't wait again for the entire day. Right? You took a bull put here. It opened nearly 20 points up. That means that would have made 50, 60% gains. Just you took at the end of the day, you are closing at the opening of the day. That's why it is called as bed and breakfast. Your overnight trades, you are just holding for overnight, and then you close in the morning time. Tag and turnaround is for 5 DTE. Whenever you see buy at the bottom, you do bull puts for example, Monday you see a buy. Then for Friday you can do bull puts. Or Monday you see a sell signal. For Friday you can do bear call. So as long as it stays below that area, then you can keep all that money. Or for example, within 1, 2 days it goes down. Then you can collect nearly 90, 80% of the premiums. You are doing a bear call, right? You are collecting premiums here. So if price keeps going down, you can keep more and more of your premiums. Right? Then iron fly is where you are selling a call, selling a put, or buying at the money call, at the money put. So like this, you don't need to, right? You will have 80, 85% success with using any of these strategies. All we need to do is follow the rule-based system, right? It is like a system. You have to follow the rules, right? For example, what this is telling, it is telling that you sell bull puts at existing. If there is already a buy, you do. Or whenever you see the next buy, you do. So if you have to wait for the next buy and you do it, then you'll easily make that 100 to $110. So you have to just follow the rules, then you will be successful. Without following the rules, if it says 20 delta, you do a 50 delta, you might be taking risk. right? But if you go with the approach, rule-based approach, you follow the rules. If you are in a sell signal, you don't do a bull put here. You wait for the next buy. You take the trades. 9 out of 10 times you will be making profits. So like that, yeah, these are the 5 different strategies you can use on a day-to-day basis to make nice profits with the SPX. So one is 20 delta in 5 minutes. One is 50 delta with 30 minutes. One is bed and breakfast with 30 minutes. Tag and turn around with 30 minutes. Iron fly with 5 minutes. So iron fly, 50 delta, credit spread. These are the same day, 0 DTE. Bed and breakfast is 1 DTE. Tag and turn around is 5 DTE, 5 days for expiring. So let me stop recording here.